Greetings and welcome. I'm SEDRIC Collins, the founding attorney at Legacy One Law Firm. And in keeping with our mission of educating and empowering the community with the importance of estate planning, today I have the privilege of speaking with a special guest, Ms. Jefflyn Dangerfield. Now, Jefflyn is a retirement specialist with Encore FFS. She's an author, podcast host, and she's passionate about providing her clients with optimal outcomes and solutions for their retirement and financial future. Jefflyn, thank you for joining us.
Well, thank you for having me, Cedric. I appreciate being a part of your platform. This is so exciting and looking forward to a great interview today.
Absolutely. So Jefflyn, tell us about you. Can you please share with us how you got started working in this particular space?
Well, I've been in the financial service space for about 12 years now. I bounced around a couple companies, but I found my footing here at Encore FFS, and I'm really excited about it. I got passionate about helping people many years ago, after coming out of college and trying to figure out what I was going to do. Helping people has always been something that I wanted to do. I knew that, the service field was something that I wanted to do. I also know that finance is something that I've always been very interested in. So I kind of plotted a course. I was in entertainment for a while, long while, probably about 20 years. I did artist development on the secular as well as the gospel side, and business management for several different artists. And that kept that financial thing going as well as helping people going. But, after a certain period of time, and I enjoyed it, had a lot of success with it, but it was time to move forward into what most people would call a real job. So I got a career with the County of San Bernardino as a financial analyst, stayed there for about 10 years. And then after that, moved into financial service space as an independent for myself. And since then, like I said, for the last maybe 3 to 5 years, I've specialized in retirement planning. And it has been an interesting ride, to say the least. A lot of people look at retirement as being the end of the scope, whereas retirement is the beginning of a whole new life. So helping people plan for that new beginning is what I do.
Awesome. So thank you so much for sharing that background. Now, as you very well know, we serve individuals and families through estate planning.
Yes.
And many of them are actually planning for retirement. So
Yes.
How does retirement planning and estate planning come together to actually serve your clients' needs?
Well, estate planning, as it will be, or, by sheer definition, estate planning is the culmination or the plan for assets, the plan for what you will do or what will happen with whatever assets that you may be leaving. And the way the two combine themselves are you have to plan your assets even prior to planning your estate. Because if you don't have the right amount of finance put away, or if you have not developed a lifestyle plan in regards to how you're going to live after you quit your or stop working at your W-2 position, then the estate plan kind of gets obscured. You don't, everything is everywhere. The retirement plan kind of helps to set up for the estate planning.
Awesome. So there's kind of a synergy that goes with that.
Absolutely.
See how the two of those go hand in hand. Now, I often hear folks say with my line of work and what I do, we don't have assets, nor can we afford any. Therefore, we do not have an estate to plan for.
Yeah.
What types of products or services might you recommend to help those who are in that position?
Well, first of all, anytime you're generating an income, no matter how large or how small, at some point, if it's only $5, you now have quote unquote an estate. You now have something that can be um, left or thought of leaving to someone else. Also, in that, if you own a property or if at some point you inherit a property, at now you have an estate, regardless of whether you are having to pay 100% for it or whether it was gifted to you free and clear, you now have an estate. So, some of the things or some of the vehicles that can help with establishing or planning for that are vehicles like that people don't think about are life insurance vehicles or health insurance or health accounts, health savings accounts, as they're called. Those are assets that would generate an estate for you. So if you have a life insurance policy, you have an estate. If you have a health savings account, you have an estate. If you, like I said, inherited a piece of property, you have an estate. If you have a checking account or a savings account, no matter what's in it, as long as it's not overdrawn, you have an estate. Um, I run into that often. People say they don't have, and more so than not, it's not what they don't have, it's what they don't save that makes the difference. But you do have an estate. So it's a change, a paradigm shift. It's the change of thinking.
Absolutely, because when I look at life insurance, or life insurance is often overlooked because I guess most people have the kind of the misconception that, oh, I only get that if something happens to me, so therefore I
Right.
don't really have that. But life insurance may be the number one ways that generational wealth is passed down, and for many of us,
True.
that might be the only wealth that we have.
That's true.
Jokingly, sometimes with my clients, I say, "Hey, when we're doing their estate, hey, you're worth more dead than alive." That's kind of funny, but for a lot of us, for most hardworking Americans, our life insurance policies can be our largest single asset, and that can be the
True.
biggest way to kind of transfer that wealth. So I see that when designing these plans. But I'm
And-
often posed with, and I'm not an insurance specialist, but I'll
mm,
get the question, Cedric, what's the difference between a term life and a whole life insurance policy? And I know this is right up your alley. So
yeah.
what do you say to those who don't really know the difference or why they should get a term life over a whole life, policy?
Well, perfect segue into that. Let's start with the difference between what, like you said, people formerly knew as life insurance. That's actually death insurance,
Mhm.
meaning that you don't utilize it until someone has passed away. But with upgrades, just like anything else, you had, at one point you had a flip phone. Now you have a smartphone. Well, insurance has upgraded itself as well. And there are living benefits that are attached to life insurance policies, which make them living insurance policies that if you need from them, you can use from them while you are alive. But to answer your question specifically in regards to term and in regards to whole life or other types of insurance, let's look at a picture of difference between renting and owning. When you rent a space, you don't necessarily own it, so you may pay a little bit less or less into that particular property than you would if you owned it. You don't have the upkeep costs. You don't have the sometimes you don't have the utility costs. You don't have the maintenance costs. You don't have any of those fees. So your rent is generally less. But what happens with your rent is when you walk away from that property, you may, if you're a good tenant, you may get your security deposit back. But after that, there's nothing for you. Well, with ownership or with what is considered, say, a whole life policy or any of the other types like index universal life policies or variable whole life policies, those things are more like ownership. You have more to pay for. You pay for the upkeep, you pay for the maintenance, you pay for the beautification, anything that goes into maintaining that property. You pay for that, but when you walk away, then you own it. And it can be an asset for legacy building or passed down generationally as you move forward. So that's the difference. Term life insurance is more like renting, even not just property, but say like car insurance. You pay for it if you need it. And that's kind of what term does. And that's why it's a little bit more cost effective depending on your budget. But depending on what you want to do with it, if you want to build cash value in it, if you want enough of a property as far as the insurance policy is concerned, where you can generate or take from it for health care benefits and things of that nature, then it's more like owning as opposed to leasing.
Awesome. That's a
So,
very, very helpful
yeah,
breakdown. Very put in plain terms. Most people can follow that and understand that, especially when you put it in comparison to like buying and renting a home. So
yeah,
what are some of the insurance game, the insurance world, the insurance products and vehicles, they've changed dramatically.
they
So
change.
what are some of the benefits of when having this type of maybe new policy in place? How can this be structured in a way that's beneficial to a family or an individual?
Very good question. Very good question. Now, just like with renting and owning property, there are specific times when you may want different types of insurance products. So, say for instance, you're looking to build cash value to help to supplement your retirement or to take care of college funding or to save for a big trip when you get ready to retire or a new car, then you're looking more at a cash value based product. And what you do is you not only pay for the insurance portion, you overfund that. So the cash value in the policy kind of acts like a savings account, but it generates and earns interest at the rate that the insurance policy is earning. So it normally earns a little bit more than what you would be generating from a bank. And it's accessible to you if you need it. The other thing about that is not just cash value, but like I said, the medical benefit riders. Say, for instance, you become critically ill. You can't perform two of your daily living functions, such as bathing yourself or feeding yourself. Well, based on the type of policy and how it's funded, based on your doctor's support of your condition, you can draw up to 90% of the face value of that policy to help and assist you with your medical care. Say, for instance, you need assistance with long-term care, such as, living facility or in-home care workers to assist you with medical structure. If it's a temporary condition, then you can take out for during the time that you need it up to 2% of the face value of the policy monthly for up to 50 months. So that's almost or a little over 4 years that you can have supplement from your insurance policy to help aid with your condition. Now, if the condition becomes terminal, and we would hate to see that that would happen, but it can pay for treatment, it can pay for medication, it can pay for travel. All these different things your insurance policy can be utilized for, and it helps you during your lifetime while you are still living. It's not just for once you pass away. So you have the cash value feature, you have the medical assistance feature, and then you have the long-term care feature. Um, other than that, you earn a higher rate of interest, like I said, which means in long story short, you're earning more money on your money than you would in most traditional safe money investments. But it's a win-win. It's a
So
win-win.
it sounds like it's a win-win. So Jefflyn, what are the drawbacks? Are there any penalties if I wanted to take out that money to use for my own, for some of these reasons that you listed. Are there any penalties for doing this?
Very good question. There are no penalties. However, you are paying for the cost of insurance. Now, here's the other thing with that. Depending on how long you have the policy, because some people, they immediately think that this is like an ATM machine, and it's not. When you set up these type products, you're looking to set them up as long-term investments, either for your retirement or for your legacy in the future. You can, upon emergency, access them, or, and that's the way you should think of it. But it's not an ATM. It's not like you're going to the bank and every 5 minutes you're drawing $20 out or $50 out or $100 out, whatever you need. It's not like that. Once you do that, that money is considered a loan. You're borrowing against yourself. Now, in actuality, it's considered a wash loan because the interest that you earn generally outpaces or is at even keel with the interest that the loan would determine. But a lot of policies are structured where the family or the person that's taking the money out, if they choose not to pay themselves back for this loan, then at the end, they don't have to pay for it. What the insurance company does is, from the face value of the policy, they take the amount that was withdrawn and then submit the remaining amount to the family or beneficiary at that time. Some people consider that as a detriment. Others consider that as a blessing because, one, a lot of people don't know that they are beneficiaries or they are entitled to this benefit at all. And two, it helps them in the now when they need the money so they don't have to draw from their regular income. The other thing is, like I said, the cost of insurance. Insurance costs go up as you age and based on your health. So that's all factored into the amount that you contribute towards your policy. And as long as you keep the policy and as long as you pay it for the time frame that's stipulated, some people with whole life, that's as long as they have the policy before they're deceased. Some people can set up or will set up policies where they only pay it for a certain time frame, maybe 10 to 15 years, they pay into it. But as long as you meet your monthly premium or annual, however you set it up, and it's taken care of for the time frame that's allotted in that contract, then there is no penalty to you.
Got
The
it.
other
Got it.
thing, the other thing, and I want to be very clear about this. Some people think because they've paid into the policy that whatever they put into it, they should be able to get back out of it. Depending on what type of policy that it is, normally takes about 2 years for the policy to be vested before you can start drawing from it. After that, if you do draw money from it, if it is before the full term of administration for that particular contract, you may not have paid enough into it to suffice that contract term. So you may not wind up getting any money back. And that's where people tend to think that there are penalties in regards to life insurance policies. There are no penalties, but it is a contract. And the contract is honored based on the commitment that you made to pay. So as long as you're paying into it and all of the administration has been taken care of on the policy, then you can draw money out without losing any money on your behalf. And I hope that makes sense. I hope I was very clear in
Yeah,
that.
it does. Thank you for that very thorough explanation. I believe we have time for about one more question.
Perfect.
So, Jefflyn, with all the options in the marketplace, how does one decide what is right for their individual or family needs? We hear about all these different products that keep coming up. Maybe how does one decide? Was there a resource that one could look to? Where do we start?
That's a great question. And the best resource is to get a good financial advisor to sit with you to review the strategy. But if you're a DIYer and you do things on your own and you're looking things up, let me just explain that a little knowledge is very dangerous. So an expert is always the best source. But if you need reference in regards to different types of products, what I suggest to most of my clients to do is term products, research term versus whole life. And then let's have a conversation in regards to where those fit or how it would fit for you, because it's going to be based on your need and what you're expecting that life insurance to do for you or that product to supplement you in the future. Say, for instance, you own a home and you just purchased the home and it's for a 30-year mortgage. Well, a good product to get to cover that expense would be a term policy because they generally last. The longest term on there is between 30 and 35 years. And what that does is it gives your family the security of if anything were to happen to you, that term policy would kick in to pay off that home. So now your family has a home and they don't have to struggle or worry about where they're going to stay if something were to happen to you. However, because term normally does not build any cash value at all, if you were looking for that to support you in your latter years, unless the face amount is enough where there's an overage and you can invest the difference, then you need a different type of product. So that's where experts and advisors come in with that. That's the difference between renting and owning. When you get ready to buy a house, you may go and look at the property that you want, but you always want a good agent or broker to help you to navigate the process. And that's what a good financial person will do for you when it's time for you to get into the life insurance market.
Awesome. And so how do our viewers find out more about you and how you can help them or how you service the community in general? How can we learn more about what you offer?
Well, you can contact me at imyouragentpc. I'm your agent, P as in Paul, C as in Charles, at gmail.com. And that's the best way to communicate with me. Also, if you want more tips in regards to finance and different structures in regards to retirement, you can contact me through my new book that's out, The Retirement Trilogy. You can get it on Amazon. You can get it through Barnes and Noble. You can also get it through Target.com. Those would be the best two ways to get in contact with me direct. And you can listen to the podcast. I'm your agent, PC, and it gives all kinds of tips in regards to structuring retirement and living during retirement and making sure that your retirement plan is on track.
Awesome. Well, thank you. Thank you so much for this valuable information, Jefflyn, that you shared today. And hey, so you heard it right here, folks. When you're thinking about your estate planning portfolio, what to add to it, you think about assets that you may or may not have. Do not sleep on the world of insurance and the value that they can add and the protection that they can also add to your assets in your portfolio. So that's it for today. Until next time, remember, we care about serving those who care about what happens to them in the event of their death or incapacity. I'm Cedric Collins, founding attorney at Legacy One Law Firm, signing off today.
Thank you, Cedric.